Hello, hello. This is Peter Nelson with Nelson Insurance Advisors, and we have here the man, the myth, the legend, Logan Hertz, Hazeltine LLC. Logan, it's wonderful to see you once again.
Great to see you again, Peter.
So we're on, I believe, part 7, right?
Part 7 of financial malpractice.
All right. So, of course, just to give a quick, real summary of this, we have a gentleman, I believe he's about 75 years old. He has a advisor that's taken him down the traditional financial planning path, the buy and hold, the higher the risk, higher the reward, and it's just a paper loss kind of strategy. And we've been taking you through all this. So this one, we're going to keep it to about 20, 25 minutes or so. But if we've really gone in depth during this whole process of what this whole email string and what this person is experiencing with their advisor, and this is going on, and my gosh, I think it right now is so important. We're probably entering a recession next year. We're witnessing the markets are volatile as anything, and then we still have this, this is experiencing this buy and hold mentality where you should just take all the ups and downs, right, Logan?
Yep, and you used a word there I want to correct you on. This is not what I would consider a traditional financial approach. It's the modern, standard, conventional wisdom, which is generally not in the client's best interest. And yeah, it's put all your money and lock it up in jail and just hope it gets bigger, right? And of course, one of the things that was interesting talking with Benton Penn about this is he asked the question, what is the surrender value of your asset, right? So if you have money in the market, this is not in a retirement account with this particular client, but still ask yourself, what's the surrender value of the money in the market? Whatever dollar amount you see is not the surrender value, because guess what? The IRS still needs their cut. So when you sell, assuming you have gains, which hopefully you do, you're not going to get all of it, right? So it's always set up in such a way that, to your point about a paper loss, it's also a paper gain, right? You can look at your statement wealth, we call it. You can look at your statement and see a really big number, but that's not your money. It's not really yours, right? You can't get access to it. It's not liquid. You have no control over it. You owe taxes on it, right? So what it allows the powers that be to do is not only to advertise a higher dollar amount, because it's really just advertising. That's not the money you actually have, right? You're going to pay taxes, fees, other things. Plus, you're going to miss out on future gains when you withdraw it, right? But also, they charge fees on the full amount. Someone I was talking to who's not an infinite banking guy, but he made a really good point. When you put money into a retirement account, the financial advisor collects his fees on the entire amount when a portion of that money isn't even yours. So if you have $1 million in a retirement account, probably at least 25% of it belongs to the IRS. Yet the financial advisor can collect his fees on the entire million. So he's collecting fees on money that's not yours. That was something I had not thought about. That's really interesting. And even in a standard brokerage account, same thing. If you have gains, they're going to be taxed, right?
Well,
So
maybe
I also,
depending. The only thing I'll mention on that is capital gains may or may not be taxed. Of course, you can actually be under the threshold.
right,
So
right.
if you have low income and actually you have gains, you can actually pull your money out of you could take your gains and potentially not pay taxes. But you're right. For the most part, right now the max capital gains is actually 20%, and that's probably going to be changing in the future, right? But
Yeah, and
anyways,
it's just a good. I think Benton is asking a good question. Whatever asset you have, what is the surrender value of that asset? That's a good question, right? I'm not saying it's a bad asset. Just understand what you actually have, right? Which may not be the same as the number on the page when you get your statement, right?
right.
Because
Okay.
in this, it's right to what I was going to revisit one thing you mentioned earlier, where this financial advisor is saying we can peel off cash from the portfolio all day long, no problem. It's like, okay, well, why hasn't he been doing that, Mr. Financial Advisor? If that were really doable, then how dare you keep all his money locked up in jail when he could have been collecting cash flow from it the whole time, right? If that was really possible this whole time, then it's irresponsible of you to not give your client the benefit of collecting cash flow, right? But of course, And then the other thing too is where he says, I don't know how you're going to fund this whole life policy. Well, wait a minute. If we can really peel off cash from the portfolio all day long, like you claim, there should be no problem funding the whole life policy. We can just peel off that cash and use it to fund a whole life policy. No problem whatsoever. Right. So he's, of course, this is all fantasy. Right. And if I ask him to prove that out, what he'd probably do is just assume we're going to get a 15% rate of return and withdraw 7% a year. Well, if you assume you're going to get a 15% rate of return every year, you can make anything look good. Okay. We all know that's not going to happen. As he mentioned, capital losses. There have been losses. And to drive that point home, a prospect I was just talking to, they really understand this because I'm always asking them, how much do your investments pay you? Okay. In this particular prospect is savvy enough. They one of them is a realtor and they have real estate investments, and they're starting to see, oh, the rental property I have, that's a real investment because I'm collecting cash flow. It's paying me, right? Whereas the money I have in this market-based account, I'm not getting any benefit from it. It's all locked up in jail. Whatever number my statement says, it's really pure fantasy. It's not like I can benefit from it in any way. It's just locked up in jail, right? So cash flow, that's what it's all about. So to continue further, which again, this is really difficult to get through. Okay, here we go. All right. So I'm just going to repeat a little bit of what we said last time. These are the financial advisor's comments where he's basically, it all boils down to keep all your money in the market forever. Any other option, I'm going to destroy it any way I can and demonstrate how much I'm not acting in your best interests, just holding on to all your money with my vice grip and showing my ignorance of these other assets. So on top of this, I don't even know how you continue to fund the policy if you live long enough. Well, if you can peel off cash from the portfolio, what's the problem? If you put $500,000 in this policy over the next 10 years, that eats into most everything that you already have. But wait a minute, if you're earning this great rate of return on everything that you have, then it shouldn't eat into it at all because it's still always growing, right? I don't understand. I thought we were going to get a 10% rate of return. What happened to that? There should be no problem. Okay. Yes, you can borrow against the policy to make distributions for your future cash flow needs. What a concession. Wow. Okay. But where does the money come from to make the ongoing additional premium payments? Well, wait a minute. I thought we could peel off cash in the portfolio. Like what? He also doesn't understand premium payments are not required, right? It's not a liability. Are dividends redirected towards paid up additions? Short answer, yes. Yes, that's how it's structured. So I guess he knows what that means. So our dividends, and by the way, Mr. Financial Advisor, that's in the illustration that you have. Why are you asking that question? You have that information right in front of you. It will tell you what the dividend option is in the illustration. So you don't even know how to read an illustration? That's a really obvious thing, right? If you know anything about life insurance or whole life insurance, duh, that's one of the first things you're going to see. What is the dividend option? Paid up additions. Duh. Right?
Yeah.
I mean,
I'm kind of betting that he probably hasn't read through too many illustrations in his career.
Yeah, and I think he might be getting his information from elsewhere. I don't know. He probably doesn't even know what a paid up addition is my guess. He probably read that somewhere or heard that from someone. I don't know. He doesn't know what it means. Are dividends redirected towards paid up additions? Yes. But what's the significance of the question? Like, where are you going with that? Is there a better option? I'd love to hear it, right?
Right. I mean,
you could take the dividends as a check in the mail, but now it's taxable income, and it's not, or and you're losing out on compound interest, right? I mean, you could surrender dividends to pay premiums. I mean, are you telling me there's a better option? I don't know where that question is going. But the short answer is yes, and you should know that because you saw the illustration. Answer your own question, right? Okay. Lastly, let us know if there's a problem or issue you're trying to solve, and we can come up with solutions independent of working solely within the realm of whole life insurance. So this is another total straw man argument, right? This is projection. I'm not saying you should do anything solely within whole life insurance. I never said you should do all your money in whole life insurance. That's not what I'm saying. But he is saying You should put all your money in the market, Peter. That will cover long-term care. That will cover legacy planning. That will cover a death benefit, right? You don't need any of this other stuff, right? All your money should be in the market forever and keep it parked there, right? That's what he's saying. What I am not saying is whole life insurance will cover you for everything. That's not what I'm saying, right? Let us know if there's a problem or issue. This tells me you're not having conversations with your client.
Right. I mean, that's a part that kind of floors me. Then why is this guy having a talk with you, Logan, if everything's honky dory, right?
Yeah, let us know. It's sort of like, Peter, you have no idea how to construct a boat engine. I give you the instruction manual and say, let me know if there's a question. See ya.
Yeah.
Right? You need to actually like take your client through a discovery process and educate them, right? And that way, if there's a problem or issue, it will be identified as part of that problem, as part of that process, right? This
But there
clearly
can't
indicates to me he is not having any conversations with his
but see, there
client
can't
in
be an
any
issue
depth.
though, because he's gonna make 15% and you should be good because we could do everything that way, right?
Yeah, yeah, yeah. You know, but okay, long-term care. That's a problem. You have no long-term care coverage at all. Oh yeah, money in the market will cover that. Right? Your paid off house is your biggest single asset. It's worth more than all the money you have in the market. Your financial advisor has not even brought up the topic of a reverse mortgage. You've never heard of it before.
No, because
Right.
it's a taboo in that on that side of it for the most part. Even though Dr. Wade found all the other guys said that incorporating a reverse mortgage into your overall, planning can be a very advantageous thing, right?
Right. But of course, like we're pointing out here, why is it on the client to tell you if there's a problem? That's your job. You're supposed to be the guide, right? You're supposed to be the financial advisor. It's not on the client to identify the problem. It's on you. Do your job, right? So when I meet with a client, we have an in-depth conversation. We talk through holistically, big picture, look at all your finances, right? And if there's a problem or something that needs to be solved, we will identify it. I don't put it on my clients to discover that. I'm the one who discovers it. That's my job. That's what I do,
You
right?
know, Logan, I just want to mention something. I haven't really talked about this before and real quick. You know, when I'm meeting with a client and I'm going to potentially open up some, a brokerage account or maybe an IRA or something we're talking now on the investment side. And I'm staring at the questions right now. They're all asking about what's your net worth, what's your liquid net worth, what's your current household income, what's your federal income tax bracket, liquidity, what's your, all this stuff. But you know what? I don't see one question asking about things like long-term care and all those things. Now, let's be honest that we would hope the advisor goes deeper, right? But as a investment advisor representative, that is not a question that I am required to actually ask. And I think that's one of the issues that we run into on that side of the business is that these guys get locked into this tunnel vision and that they don't dig deeper. Right.
And they're not incentivized to, and there is no big picture thinking, right? When I deal with a client, the first thing we do is have an open-ended conversation where I ask open-ended questions like, what are your goals? What are you worried about? Right? Let's talk about that. Big picture. Before we get to solutions, before we get to your income net worth, forget all that. Let's first talk big picture, qualitative. What are you trying to accomplish? Right? And then I can help you get there. Right? But yeah, they're going through a series of very close-ended questions designed to extract as much money as possible from you into the market, right? Because in their, they're not even illustrations. They're just going to assume some rate of return so they can show you a big number, right? And the client just sees a big number and isn't really fully explained to them all the assumptions that go behind that, right? And none of those assumptions are ever fully justified, right? Prove to me that this is going to get a 12% rate of return over the next 30 years. Like, prove that, and of course, again, as we point out, the number may not be what you actually have, especially if it's in a retirement account, right? How much of that money is actually yours? How much income were you collecting along the way, right? And what happens? Let's stress test it. What happens if you have a long-term care event, if you get cancer, if your house burns down, if you die? What happens, right? All that is accounted for in the sort of plans that you and I built, Peter.
Yeah, I mean, I saw one a couple of years ago. It was the guy ended up getting dementia, just wouldn't, I hate to say this, but just wouldn't die. He lived in his vegetative state. Now that's kind of, it doesn't happen all the time, but like 10 years, it wiped them out, right? This stuff does happen. And yet I'm pretty sure the plan that he currently has, if that were to happen to him, they would get wiped out pretty quick.
Oh, absolutely. And let's be honest, there is no plan. It's not a plan. Okay. The client admitted to me there's no written plan. I was like, is there a plan? He's like, well, there's no written plan. I'm like, okay, so there's no plan, right? Period, right? So yeah, no, you're right, Peter. I met with a client. Okay, we earlier today, he just discovered he's in his late 50s. He just discovered he has a serious heart issue and he probably has less than 5 years to live. If he had been dealing with this financial advisor, he would be in serious trouble. Okay, he's 58 years old, but he also has dependents. Really, he still has people who are depending on him financially. Thankfully, he has a very nice whole life policy that is designed for infinite banking with a $2 million death benefit, and he has a convertible term policy for $2 million. So guess what we're going to do? This is the beauty of a convertible term policy. Now we can convert it. He doesn't have to go through underwriting anymore, right? He has locked his insurability in place. He protected his insurability. So now he's not insurable, but he still has that convertible term policy. So we can convert it to a whole life policy. He'll be in great shape. He's going to have $4 million of total death benefit, permanent death benefit that he can draw from should he have a long-term care event, which is more likely now, right? Or when he dies, is going to go to his heirs. And I partnered with this estate planning attorney. We've got the estate plan in place. We're going to have a trust in place, right? So that it'll all be managed properly. His plan is working just fine. It was not derailed at all by the fact that he developed this serious health condition, right? If he had all his money in the market, what would he do? I mean, what would he do? How would he address this? You know?
Yeah.
So
no, that's, kudos to you for going through that process with him. And I know we both believe in the fact that, here we are talking about, infinite banking, using whole life insurance for it. And yet we're talking about term life insurance, right? And see, when you really go into the planning, there's no bad, it's not this, I can't stand this term versus whole life. No, you actually integrate it in when it makes sense, right?
That's absolutely right. Convertible term policies are part of the infinite banking and the solutions that I build. Like we're talking about, you and I, Peter, we take a big picture approach. Unlike what this guy is claiming, I'm not claiming a whole life policy solves all your problems. Clearly, with this client, we have a whole life policy and we have a convertible term policy. He also has assets in the market. He has assets in a retirement account, right? He has all that stuff. That's fine. He owns, a house, right? He has those assets in place. So I'm not saying the whole life policy takes care of everything. It doesn't. Okay, but it does many things that money in the market can never, ever, ever do. And so, yeah, convertible term is a very important part of the overall financial solution.
Right.
So yes, good point.
Take us into one more, then we got to wrap this up here. So,
okay. We don't see any immediate issue that needs resolution. Oh, you're a 75-year-old type 2 diabetic. Okay. You don't have enough money to retire on, clearly. Okay. You have no plan for long-term care, right? You have no death benefit, no legacy plan in place, but they don't see any immediate issue that needs resolution. And you have all of your money in the market. Wow. We don't see any immediate issue that needs
how
resolution.
much are they? I'm just curious. We probably talked about this before. How much are they pulling out? Do you know what percent they're pulling out of the portfolio for income, or are they not even?
Oh, no, he didn't give a number. Of course not. That's just fantasy. He's just saying, oh yeah, we can peel off cash. And of course, my question back to you in our last call. Oh, really? I'd like to see that plan. Please show me how you're going to collect cash. Again, if this is true, why have you not been doing this the whole time? If
so they're not even taking any cash out right now?
No.
Wow.
I mean, again, it's like if it were true that you could continually peel off cash from your portfolio, why wouldn't you do it? Why wouldn't you be collecting cash flow this whole time? That's what real estate investors do. They don't let the property just sit there and not earn for them. They're going to collect rental income. They're getting their cash flow the whole time, right? That's what we can do with whole life. The cash value is growing, the death benefit is growing. Meanwhile, we can collect income by strategic use of policy loans the same way a real estate investor does it. We can collect cash flow from it. Liquidity, access, and control. Liquidity, access, and control. That's what we get in our whole life policies, which you do not get here. It's the opposite. They're taking money away from you. They're taking liquidity away from you. They're taking access away from you. They're taking control away from you. And if you want that money that supposedly is yours, you got to beg your financial advisor and you got to fight him to get it. And I've seen this. This other prospect I was meeting with earlier today, they were talking about how they had money not in a retirement account, in a brokerage account, and they needed to withdraw a significant portion of it for some unexpected expense. It took them 6 weeks to get their money. 6 weeks, and this is supposedly their money, right? Liquidity, access, and control.
That frustrates me too when I hear that, because I mean, one of the things that's nice about a brokerage account is you should, I mean, now granted, depending on the investments you have in it, it should be fairly liquid, you would hope, right? Shouldn't take 6 weeks. I know that.
Yeah, this is what happens when people give up decision-making control to their financial advisor. If you want to hire a financial advisor, that's fine. There are great financial advisors out there. I know some. I can introduce you to them, so it's not a problem. But you have to take responsibility for your decision making. You should know what your financial advisor is doing and why he's doing it, right? And you should be able to get access to those funds, right?
Yeah, I mean, gosh, you can literally just link an external account to your brokerage account, and there you go. The money can get moved right over. It's literally that easy.
We don't see any immediate issue that needs resolution, let alone the need for this policy. Well, again, I didn't say you need it, right? You don't need money in the market either. You don't need a financial advisor either. Right?
Yeah. Can I get that in writing, please? Can I get that in writing that you do not need any life insurance or any long-term care insurance? I want to see that in writing right now.
Well, no, he does give it to you in writing. Here's what he says. This will make you really angry. We can always look at items like an annuity or LTC insurance in a vacuum to mitigate costs.
In a vacuum?
In a vacuum to mitigate cost. What are you talking about? Okay. In a vacuum to mitigate costs, but we don't think those products are particularly applicable given your current strategy. Well, I guess that's technically true because your current strategy is put all your money in the market and pray for the best possible return. So I guess it's not really applicable given the current strategy. But there you have it in writing, Peter. You don't need any life insurance. You don't need an annuity. You don't need long-term care. You got it in writing.
Well, it is in writing. And you know what? If anything happens, that client has it in writing, and hey.
Lawsuit? I mean, I'm not trying to encourage a litigious society, but I would say that's grounds for a lawsuit. This guy is clearly not acting in your best interest.
I mean, he has to. I mean, the thing is with that is, I mean, if they would have to show that there was damage done. Now, if they end up having a major issue,
long-term care event, yep, or death, right?
I do not want to be that advisor. I mean, you're done for. If anything happens, he's pegged.
An annuity or long-term care insurance in a vacuum to mitigate costs. Because, Peter, you take out an annuity to mitigate costs, right? What's he talking about? No one takes out an annuity to mitigate costs, right? I don't take out a long-term care insurance policy to mitigate costs, right? The point is to protect myself against the need for long-term care, right? An annuity provides guaranteed income, so I can't outlive, so I don't run out of life before I run out of, or I don't run out of money before I run out of life, which I've seen that happen, right? So, yeah. And when he says in a vacuum, no, you're the one operating in a vacuum. This is, again, projection. I'm the one taking a big picture approach, situating everything within his overall financial picture, like a reverse mortgage, which you never brought up, right? You're the one who's operating in a vacuum, who's just myopically focused on put everything in the market and pray for the best possible return. And that'll take care of everything.
Yep.
So you heard it, folks. You don't need life insurance. You don't need an annuity. You don't need long-term care. Having money in the market accomplishes everything.
Yep. So the report that Ernst & Young did that I like to talk about, Ernst & Young they have no idea what they're talking about. You should all the money should be in the market, and you'll actually be better off because there's math to prove it. Oh, wait, there's not.
And it's not a market, right? When we say the market, he means give it to me, right?
Yeah.
That's what he means. Give it to me. Come on.
Give me your
And,
money.
and by the way, you cannot get any of it ever, right? I'll pretend like we can peel off cash, right?
If
But
I'm in a good mood one day, I might give you a little bit of it.
Four
Right?
rules of financial institutions. Give us your money. Give it to us on an ongoing systematic basis. Let us keep it for as long as possible. And if and when we give it back to you, we're going to give it back to you as slowly as possible.
I love those. I like to actually go back in these videos and actually watch those 4 points because they are so true. I love them. So, all right, Logan, we got to wrap this up.
Okay.
So I guess we're gonna do a
We're
part
gonna
8
do a
of
part
this.
8. We're gonna do
All
part.
right.
Maybe it'll end up being 10.
Yeah, that'd
But
be
yeah,
good.
yeah.
So-
Thanks so much for your time, Peter. I greatly appreciate it. I hope people are learning from this, because this shows how we it's sort of like a character foil. This is how we distinguish ourselves from what is the conventional so-called wisdom, right? And you're seeing how behind all of that so-called conventional wisdom, it's really just sales and marketing to sell you mutual funds and retirement accounts. That's really what it boils down to. There's no actual financial framework that's being used. Rich people don't do this. They do not buy mutual funds and use retirement accounts.
Okay. Well, thank you, Logan. I enjoyed it like always. And everyone have it's actually Friday. So everyone have a great weekend. God bless and Godspeed.
God bless. Godspeed.